Hello again. We continue the Training Academy project on top-rated forexbrokers.com by explaining the elements of a trading account. What are the elements of a trading account? We will talk about the balance, the equity and the free margin. This is not only for the MetaTrader, the MetaTrader platform live account offered by the broker, but it is valid for any trading account. It doesn't matter what the trading platform is. These elements are very important, and the focus should be on the equity and not the balance. Let's assume we deposit $1,000 in this trading account. By the time that we do that, the balance will be $1,000, equity $1,000, and the free margin $1,000. What is the free margin? The free margin, or the margin in the trading account, represents collateral that the broker requires. For what? The broker intermediates between the retail traders and the liquidity providers. Therefore, the retail traders can access the interbank market. To access the interbank market is very expensive. As such, brokers offer leveraged accounts. You have the possibility that when you open a trading account to choose your leverage. The broker offers different types of leverage, different sizes of leverage. You may choose, for example, 1 to 200 or 1 to 100. That means that effectively $1 in your trading account will move in reality on the interbank market, on the real foreign exchange market. $100 if the leverage is 1 to 100. If it is 1 to 50, it will move 50. If it is 1 to 1,000, it will move 1,000. So if you invest or if you buy Euro US dollar, you buy one lot of Euro US dollar and the required margin will be blocked here. The margin blocked, or the collateral, the broker will release it the moment that you close the trade. Either you close your trade in profit or with a loss. The moment that you close the trade, the balance will change. If you made a profit of, let's say, $100, it will show $1,100. If you made a loss, it would show $900. If there are no other open trades in the trading account, then the free margin will be the same, like the balance, and the same like the equity. The most important element here is not the free margin or the balance, but the equity, because traders tend to lose focus. The focus should be on the equity. Why? Well, let's assume that we buy Euro USD right here. We go along one lot. By the time that we go along, the positions here will change with one exception, and that is the balance. The balance will change only when the euro dollar either reaches a profit or the stop loss, or if we effectively close it at market. The balance will change with the outcome of that trade. The equity will change in the blink of an eye. So why is that? Well, when the markets are open, they move all the time. The moment that the trade gets executed, either from a pending order or you trade on the market, it does not matter. The equity will change. If we bought the Euro US dollar, for example, and the market goes in our favour and we buy at 1948.8 and the market goes to 120, showing us a profit of 51 pips, anytime the market does that, the balance will stay the same, but the equity will increase. Assuming that we add the $1,000, the equity will show the $1,000 and the profit. This is called the unbooked profit or paper profit. On the other hand, if we go to the market and buy the Euro US dollar at 1948, and if the market effectively collapses more and goes to 119, 118.50 or 180, and we don't have a stop loss, then the equity will shrink and shrink. The free margin will become less and less. You will have less free margin available, and you cannot trade anymore. By the time that the equity effectively disappears, then the balance will still show you $1,000, but actually the value of your trading account is not in the balance, it is in the equity. The focus should be on the equity at all times. It is very important, for example, when a trade goes in your favour. It shows $2,000 here, so you have a $1,000 in profit. This should be your focus. The free margin, or the margin available for trade, increases with winnings and decreases with losses. Let's assume that the market goes against you, or you open too many trades. If we buy a lot of Euro US dollar, then we sell Aussie dollar against the New Zealand dollar, or we buy Euro and Aussie dollar, and so on. Well, at this moment, we'll have 3 or less free margins available, and then the market goes against us, and then there is no margin left to trade. The broker will send you an email, a so-called margin call. It will say, I will close your positions, or some of them, for me as the broker to free some margin here, or please deposit some more funds into your trading account. Usually, or typically when you receive a margin call, it means that the market went against you and you were not able to get out. Something went wrong. You either didn't have a stop loss or you left the market to come to you, and so on. And not to mention that you didn't have a sound money management plan. Not all trading pairs have the same cost. Buying one lot in Euro USD requires one margin or a specific amount, but buying one lot in New Zealand dollar US dollar, for example, is less expensive when it comes to the margin used. This is both an advantage and a disadvantage because it leads to overtrading in your account. Trading currency pairs that require few margins lead to overtrading in the sense that you will open a new trade. You will see that you have more margin available and you will want more money because this is what humans do. We are greedy people, and the next thing you know, the account is gone. But what's important to sum up is that from these 3 elements, the equity is the focus, not the balance. It shows you how much money you have in your pocket, namely on the trading account.